Well, we all know the history of the Federal Reserve System, the Fed. We just celebrated or memorialized its centennial back in 2013, and independent agency deriving its power from Congress initially. The Fed's power has significantly expanded, I believe, and while originally created to supervise and monitor the banking systems of the United States, the Fed's role has continued to grow seemingly unchecked into its current position of being a lender of last resort to banking institutions that require additional credit to stay afloat. Given the interconnectedness of the global financial system, there's no doubt that the Federal Reserve's monetary policies have significantly impacted the international markets and foreign economies as well as our own. And with the implementation of artificially near zero interest rates, QE1, QE2, QE3, QE infinity, it seems, Operation Twist, Fed has made an attempt to stimulate the domestic economy by using an unprecedented level of interventionist policies. However, the result of this experiment has caused investors to take increased risk and look internationally in search of higher returns. And I think this chasing a yield has certainly affected real estate markets, and we're seeing that, which just begs the question about risk levels and all the other things that are happening. When we did the Centennial Oversight Project, we examined the Fed's actions over the last 100 years, and it became clear to me that the Federal Reserve has gone above and beyond its original mission statement. In fact, since the enactment of Dodd-Frank, the Federal Reserve has gained unprecedented power, influence, and control over the financial system while remaining shrouded in mystery to the American people, I think, and to most members of Congress and those that are even interacting. A couple of examples. The Dodd-Frank Act created the FSOC, super regulator over the U.S. economy, and driving force behind FSOC is the Federal Reserve. By empowering FSOC to designate SIFIs, G-SIFIs, Dodd-Frank allows the Fed to impose bank-like standards on non-bank institutions. In other words, to move institutions from the non-bailout economy to the bailout potential economy. And the Fed is also a member of the Financial Stability Board, an international super regulator whose activities the Fed has never reported to Congress on fully. Additionally, costs of Federal Reserve regulations resulting from Dodd-Frank are exploding. Thus far, the Fed has written over 60 new regulations, totaling thousands of pages. And in fact, 2 new Federal Reserve rulemakings issued just last month have pushed Dodd-Frank's total financial cost past the $35 billion mark. Needless to say, the Fed's recent, quote, high degree of discretion, I love that phrase. It shrouds it in some mystery, doesn't it, right? A high degree of discretion, which I think layman's terms for us, simple gravel pit owners making it up, and its lack of transparency on how it conducts monetary policy suggests reforms are needed. Likewise, I'm also concerned that the Fed's regulatory policies and the development of these policies are desperately in need of some transparency. Simply layering one uncoordinated mandate on top of another without examining the impact on hardworking American families and small businesses on Main Street is unacceptable in my mind. The Federal Reserve has proven time and time again that its government knows best approach doesn't hold the cure to what ails our economy. Not only are innovators, entrepreneurs, and job creators uneasy to invest because of the environment created by this failed framework, hardworking middle-class families are paying the price as well. And it's time that we restore certainty as well as fiscal responsibility. Well, today, somewhere north of $4 trillion, almost $4.5 trillion in total assets. Fed's balance sheet is almost 5 times the size of its pre-crisis level and represents 1/4 the size of the entire U.S. economy. That's a big number. The Fed, again, I got to put this in gravel pit owner terms, as we try to go in and explain this. The Fed's balance sheet demonstrates attempts to push monetary policy past its most basic mandate, which initially was price stability. When the Federal Reserve was created, it had a single mandate, price stability. In 1977, we had the Humphrey-Hawkins Act, as Mark had talked a little bit about, instructing the Fed to pursue 3 goals: stable prices, maximum employment, and moderate long-term interest rates. Some, like myself, believe that the employment component, at a minimum, has diverted the Fed's attention from the more important issue of low inflation, which, in my opinion, should really be maybe even the sole focus. In the worst case, an equal price stability and employment mandate has the potential for moral hazard, with the Fed playing off of its regulatory role against its monetary role. Absent a monetary policy that dutifully promotes price stability, economic opportunity will continue to fall short of its potential, I believe. I've continued to encourage the Federal Reserve to adopt a rule-based or guideline-based approach to monetary policy and to communicate that guideline to the public. Oftentimes, as it's referred to as the Taylor Rule, as Dr. Taylor is here. We've had this conversation. I had both privately and publicly suggested that my legislation says to the Fed, you know what? We're not tying you to any particular guideline or rule. You tell us what benchmark that you want to use, and then just report to that benchmark. Call it the Yellen Rule. I don't care, whatever it might be, but we want to just look at what we are measuring against. And I think that the Fed ultimately must be accountable to the people's representatives as well as to the hardworking taxpayers themselves. So we need to modernize the Federal Reserve and bring it into the 21st century, which is why we've introduced H.R. 3189, the FORM Act, Federal Reform and Modernization Act, Oversight Reform and Modernization Act. As Mark had said, we are expecting and hoping for action on that, hopefully even this coming week. That I think you will be very pleased and see the big guns of the House lining up in support of this, and we expect much as it came out of committee, it will pass the House of Representatives as well, and then it will go into. It will go into whatever process happens in the Senate. So we're definitely looking forward to having that interaction. Maybe I shouldn't have sighed so strongly at that point, but this legislation increases transparency by requiring the Federal Reserve to disclose the salaries of highly paid employees. It strengthens the independence of the Board of Governors by allowing each governor to hire 2 staff members to provide expert advice independent of the Fed chair's influence. Also requires Fed employees to abide by the same ethical requirements as other federal financial regulators. I think that would be an important thing. What's good for the goose is good for the gander. The FORM Act will also start to pull back the curtain at the Fed and increase accountability and transparency by doing such things as limiting Fed officials' blackout periods to discuss policy with Congress. So sometimes we'll get that, well, sorry, we can't talk about it, we're in a blackout period. But it can't give you a real specific date or a real reason. It just seems like sometimes it's out of convenience that they're not able to talk to us or share with us certain things. Opening the rulemaking process and then requiring the Fed to provide a cost-benefit analysis for every regulation that it issues. And I should note that it also has a look-back provision as well, as we can go back and look at and examine that. H.R. 3189 also improves the voting membership of the FOMC by eliminating seat supremacy and ensuring each district bank president would be a voting member of the FOMC every other year. In plain language, it means the New York Fed would no longer have a permanent seat. It would be on the rotation basis, and every other year it would be at the table as a voting member, just like every other Fed president. And the Fed presidents that are sitting here looking at me definitely have their poker faces on right now, as whether that's a good thing or a bad thing. But Charlie Ploser just laughed harder, so it's there's a certain freedom in being retired, right, Charlie? Right. So I think that would be an important element in the conversations that we've had behind the scenes, as well as some of the public conversations. But to be able to equalize that a bit, it also requires that the FOMC set interest rates on balances maintained at the Federal Reserve Bank by a depository institution, and strengthens the GAO's authority as well as its ability to audit the Federal Reserve operations. We've had a number of conversations about what exactly does that mean. It does have a provision for a one-time audit. We're working through exactly what that may mean for ongoing audits. Much like other elements within the Fed that do get audited, there's an exemption for monetary policy, and we're examining how to deal with some of the potential unintended consequences of that. But ultimately, my legislation also reforms the Federal Reserve's emergency lending powers under 13.3. That is, I believe we need to close that loophole and prevent the likelihood of future bailouts. That is something I believe needs to be addressed. Chairman Hensarling has a very strong feeling about that as well. During the financial crisis of 2008, the Federal Reserve used extraordinarily broad powers under Section 13.3 to provide trillions of dollars in low-cost loans to a handful of massive financial institutions. The FORM Act raises the bar from the current trigger, permitting the Fed to invoke its emergency lending powers only upon finding that the, quote, unusual and exigent circumstances, which is what the language reads now, we would have it read the, quote, unusual and exigent circumstances exist that pose a threat to the financial stability of the United States. That last part was something that I was asking Chair Yellen at our last hearing last week about. I did not get a real clear answer. It's tough trying to tackle all this stuff in a 5-minute question period. But we're going to be pursuing that as to what would be the reason for the Fed's barrier for that additional language, and it also mandates, and I really like this as well, the belt and suspenders approach to it. It mandates, in addition to the current requirement of 5 of the 7 Fed board governors approving a 13.3 facility, that 9 of the 12 district Fed bank presidents must also approve. So that is, everybody's been kind of quiet behind that. Some have been quietly pushing back. You may guess that that may be more of the Board of Governors folks and their supporters. There's a number of others who think that would be a very positive thing, and lending some voices to this. And my reason for putting that in and wanting to have an emphasis on that, and I know this is the same thing for Chairman Hensarling as well, is we want to make sure that it just doesn't collapse to a very small group of individuals who may get sort of mono-focused on something. We want to make sure that there's as many voices as is possible within that realm of functionality. And I think those Fed bank presidents, and I'm not just sucking up because they're here, a couple of them, but I really do think those Fed bank presidents have unique views and experiences outside of New York and outside of Washington, D.C. that will be very valuable voices, and I want to make sure that those voices are heard if we are going to go down the road of using 13.3 again. So. And finally, the FORM Act requires the Federal Reserve to adopt a rules-based or guideline-based approach to monetary policy instead of continuing the ad hoc strategy currently being employed, and communicate that rule to the public and to Congress. And we cannot have such a powerful entity within the federal government operating on a whim. This legislation codifies common sense principles when determining monetary policy and will develop a foundation for a rules-based monetary policy that will constrain the Fed's discretion without sacrificing the Fed's independence, in my opinion. It will also allow the Fed to be more transparent in formulating and communicating monetary policy to not only market participants, but also to the American public.